Hey everybody, John the Economist here with another video, and I just kind of wanted to have like an honest conversation about contextualizing all of the things that are currently happening in not only the American economy, but really our global economy, and all of the different things that I think are going to have a pretty dramatic effect on everyday people's lives and are pretty negative for the economy. Um, I don't think it's an overstatement to suggest that the current economic conditions are probably about the worst that they've been since 2008. Um, the reasons why I don't think you can draw a direct parallel to. In fact, there's a lot of different factors that play into this. The inflationary situation looks more like the 1970s. The asset bubble popping looks more like the early 2000s, and right now, housing market pressures I think are representative of 2008. So that's great. We have three different factors that all caused recessions in previous American history, all kind of playing together at once right now in an unfavorable way. So the main thing that I want to draw our attention to, and then we're going to get into a broader conversation about the effect this has on markets, is that the Federal Reserve recently decided to once again raise interest rates. They this past month, September, decided to do yet another 75 basis point increase. And they also stated that they expect to do several more increases over the next few months. Projections for a terminal rate, which means the rate that the interest rate gets held off at, that becomes steady at, is now upwards of 4.5%. So taking a look at this interest rate, this is actually the first time since the 1970s that we have had a cyclical higher high on interest rates. What does that mean? It means that every single time that we've actually gone through one of these cycles, you can see here, right? Raising rate cycle, then you have a cycle where you're decreasing rates, then you have a cycle where you're increasing rates, but it's a lower high from the last cycle, right? Then you have another cycle where you're increasing rates, but that's a lower high from the last cycle. And you have a cycle where you're increasing rates, but it's a lower high from the last cycle. So for the first time since the 70s, this cycle actually clearly shows that we are raising interest rates higher than the last cyclical high. And I think it could be fair game that we actually visit this level back from the mid 2000s. Before we actually reach our terminal rate. Okay, so what does this mean? This means that the cost of interest on money is higher than it previously was, which naturally sucks liquidity, money, out of the market that can be used, which naturally is going to slow down the economy. In fact, housing market interest rates are the highest they've been since pre 2008. Currently, I'm seeing averages upwards of 6.5% to 7%, depending on your state, area you live in, things like that. Very, very high interest rates. If you were to buy a $400,000 house in 2020 versus today, the interest that would be charged on that over a 30-year period would be upwards of $150,000. So, it's no joke. It's having a very dramatic effect on the way people assess buying their houses, the way people assess debt and credit and things like that. So I'm going to put a brief pause on looking at charts and actually kind of go and show you guys what Chair Powell's actual comments were at this most recent FOMC meeting. Just so you know that, like, this is not speculation. This is not commentary that I'm putting over these things. This is not me like guessing what the Federal Reserve is going to do. Here's the actual script of what happened during this press conference. And I just want to draw attention to a few very specific comments that I don't think they're joking about, right? I don't think Chair Powell would actually be making these comments unless he was very serious about his convictions that these are things the Federal Reserve plans to do, and this is the effects that this is going to have on the economy. So the first one, in his opening statement, he says that the median projection for the unemployment rate is to rise above 4.5%, which is well above the current level that it's at. And he essentially says throughout this entire conference that the Federal Reserve is going to raise interest rates until something breaks. They don't care about the stock market. They think that the labor market still has way too many job openings versus the amount of people that are looking for work. And he thinks the housing market is running hot. And he is committed to raising interest rates until inflation is back down to the Federal Reserve's 2% target. And that is going to come at the cost of the stock and equity market and really investing in general. It's going to come at the cost of unemployment, and it's going to come at the cost of the housing market. And he states these things directly in the script. Other things that he said. So 4.4% at the end of this year, with percentage point higher projected in June. The median projection rises to 4.6 at the end of the year and then declines to 2.9% in 2025. This is the appropriate level for that federal funds rate, which again, federal funds rate currently, I believe, was at 2.5%, which means they are going to raise roughly another 200 basis points before they think they are done raising rates. They probably will continue to raise interest rates, assuming inflation has not come down by then. So you'd like to hope that inflation does start coming down by then, because they will keep raising interest rates otherwise. And again, the point of this, in their opinion, is because having inflation becoming entrenched is going to cause a lot more pain in the long term than just ripping off the Band-Aid now, cranking up interest rates, and putting a slowdown on the economy. We've always understood that restoring price stability while achieving a relatively modest decline, or rather increase, in unemployment and a soft landing would be very, very challenging. This is exact opposite of what Powell was saying about a year ago, where he said he thinks a soft landing is more than likely. That's what we're aiming for. Now he's saying that we're kind of in a condition now where inflation hasn't gone away. The likelihood of a soft landing is a lot lower, which in other words is saying this is not just going to be a brief economic slowdown. There's a chance that this is actually going to cause a recession, right? So he says that chances of a soft landing are likely to diminish to the extent that policy needs to be more restrictive or restrictive for longer, which is the assessment they've essentially come to, is that they need to keep interest rates high and liquidity out of the market for longer than they originally anticipated. Nonetheless, we're committed to getting inflation back down to 2% because we think failure to restore this price stability will lead to far greater pain later on. One thing that's really frustrating to me about this is I just don't think we needed to lower interest rates as low as we did during COVID and essentially print money for an entire year and a half, right? The reason inflation has become so entrenched is because of the fact that we made money so liquid for so long that it caused bubbles everywhere. It caused asset prices to rise everywhere. So, the demeanor of this, like, in his tone with this being very hawkish, which means, they're going to be restrictive on the economy, is suggesting that, like, it's the, America's fault for not behaving properly when we printed 40% new money into the money supply over the past year. And now, like, he needs to punish that bad behavior by rising interest rates, when it was the Federal Reserve, in fact, that printed money in the first place. And now they made a mistake and they need to suck up that liquidity. And the American public is on the receiving end of that bargain, right? And he's essentially stating that outright, that this is going to cause recessionary pressure in the market. To what extent, he doesn't know, but he's pretty confident that it's going to cause a recession. We believe we need to raise our policy stance overall to a level that is restrictive. And by that, I mean meaningfully putting meaningful downward pressure on inflation. So again, he says that today was a 75 basis point increase, but he expects, 125 basis point rate increase. So they're going to keep raising rates through the end of the year. Sorry, I'm not trying to sound redundant. There's one more comment a few pages down that I think is, for the longer term, what we need is supply and demand to get better aligned so that housing prices go up at a reasonable level at a reasonable pace and people can afford houses again. And he says essentially that probably in the housing market, we'll have to go through a correction to get back to that place. So he's stating outright that unemployment is going to rise. They're going to keep interest rates at a restrictive level for quite some time. They're going to continue to raise interest rates until they see inflation come down, and the housing market is likely going to have to go through a correction for these things to happen. He's stating these things outright, right? This is not speculation. This is literally him laying out what the plan is for the future of the economy for the next couple of years. They're going to be very hawkish. They're going to be very restrictive on interest rates, and that is going to cause recessionary pressure on the economy. So I just want to see, where that has led us to date, right? Because this narrative isn't necessarily new. Just it's become a lot more unapologetic as of the past couple FOMC meetings, where like again, originally it was like soft landing. We're going to have to raise rates for a little bit to get inflation down, and now it's like, yeah, this is going to cause a recession. So taking a look at the Dow Jones Industrial Index, and I'm taking a look at the weekly chart here, right? We're actually sweeping below the pre-COVID high, right? So before the COVID crash and then the crazy bull run that followed that COVID crash, we are now below that level, right? So if you were invested in February 2020, you've enjoyed this entire bull run, but now you're actually back to break even or lower. So that is something to keep an eye on. This is also putting in yet another lower low on the market, right? And honestly, I think, we have lower to go from here. I do not think this is the final low that we are going to see. I said, in previous videos, and you can go and look at my previous content to hear me say this, there's these three conditions that we're keeping an eye out for. And unless those conditions change, we can expect lower, asset prices across both the stock and the crypto market. And not only that, but like I'm feeling that we are getting exponentially closer to a more violent move down, right? This has been a pretty orderly selling pattern of, making lows, making a high, right, rallying, making new lows, making a high and rallying, right? We haven't seen like that scary downward capitulation like you see when markets do kind of bottom, right? We saw that in the COVID capitulation right there. And then if I were to take us to 2008, right, you have another large capitulation right there. And then you can take us back to 2000s where you have, again, another sizable capitulation right here, right? Um, and, taking 2008 as an example, if we were to take a bars pattern of this, and again, this is all speculation here. This is where we're just kind of projecting. But if you look at the pattern of this bear market, very similar shape to 2008, right? And it's not the easiest to see in the world, but right, like literally to the week, you're getting rallies, decline, rally, decline, rally, decline. So if this were to follow the same pattern that we saw in 2008, which not saying it's going to, but if it were to, we'd see another very weak rally take place over the next 2 months or so, followed by a capitulation. I'm feeling like that capitulation tension, that tension that needs to get released in the market, it might even come a little sooner than 2 months, right? But I'm relatively convinced that we have not seen like that violent move down that kind of marks a cyclical bottom in our markets. Personally, I could be wrong. You shouldn't take what I'm saying to the bank. This is just personally what my analysis suggests based off of the comments that Chair Jerome Powell made about the economic conditions that we can expect to endure for the next year or so. NASDAQ and the S&P 500 do also tell similar stories. Now, not everything is negative. For example, commodities have actually fallen down significantly over the past year or so, which is great. We'd like to see that continue. That means like, raw materials like lumber and oil and steel and things like that are coming down, which you obviously like to see. You'd like to see those continue to come down to the point where it's not so costly to then, do different types of economic activity, be it manufacturing or building homes or stuff like that with those raw materials. So that's something we'd like to see. Additionally, I don't have the chart pulled up, but global supply chain pressure has come back down to realistic levels. It was very highly elevated back in February. with Russia's invasion of Ukraine, plus all of the other issues that we were having. But that supply chain pressure is also starting to come down, which probably is also having a hand in lowering the cost of commodities, raw materials, and things like that. Okay. Another thing that is worth looking at, and I'm not a big foreign exchange markets guy, so I don't know if I have charts for it, but it's worth noting that the euro, the British pound, and the Japanese yen have all seen really significant downward pressure versus the US dollar. And it's crazy because, yes, while the US dollar has had really bad inflation pressures, its strength has actually been incredible versus other currencies over the past few months here. It is not an understatement to say that this is probably the most, or sorry, not an overstatement to say this is probably the most volatile we have seen foreign exchange markets in my lifetime, at least, with the pound, the euro, and the yen showing some of the worst weakness against the U.S. dollar that we've seen. Some of this is partially to their economic conditions. Some of this is like this global currency meltdown that I think is happening because we globally made the mistake of printing way too much money, and now we're seeing the negative results of that. And I also think this is the fact that the Fed actually did move to be more hawkish on interest rates a little bit sooner than these other countries, which is making the United States dollar look very attractive versus these other currencies. Additionally, the treasury markets have also been incredibly volatile. That is worth keeping an eye on. It does not bode well for an economy when treasury markets get volatile. They usually tend to get volatile during times of recession. And you can see just what I mean about how volatile they've been. If you this is a weekly chart that we're looking at here, right? I have a nice little supply and demand chart. It's a nice surprise, right? Like lots of volatility in a very short amount of time. The 2-year, the 10-year, and unfortunately, I don't have a 30-year, so excuse me, but it's been crazy out here, right? I would argue this is a very unhealthy amount of volatility when we're seeing things like treasuries and foreign exchange markets trade with volatility that we see in like tech stocks or cryptocurrency. And again, I don't think I'm really overstating the severity of that. It is super serious. Last thing I'm going to take a look at is Bitcoin. No point in taking a look at anything else in the crypto market because Bitcoin is king, especially in a bear market. So if you're trying to get like a decent index on how healthy the crypto market is, Bitcoin's probably your best bet. This is not financial advice. If you're thinking about investing in cryptocurrency, I would be very careful. That is a very risky bet in a bear market with this much recessionary pressure. With that being said, I am a Bitcoin bull, and I do, full disclosure, make regular buys into Bitcoin at its current price levels. With that being said, what I have been pleasantly surprised by is the relative strength of Bitcoin during this period, right? And I know it sounds hilarious to say, wow, Bitcoin's showing a lot of relative strength when it's down 73% from its all-time high. However, if you look, this weekly candle is still actually showing some green here, or in my case, blue. While if you look at weekly candles on equities, that is not actually the case. So Bitcoin is hanging in there pretty well. I think part of the reason why is because there's been so much foreign exchange and currency volatility that people are beginning to look at Bitcoin as an attractive alternative. And I do plan on making a longer form video on why I think Bitcoin it is such an attractive and important asset, especially during the times that we're living in, that I hopefully will be posting sometime within the next week. So be on the lookout for that. To wrap up here, there's 3 things that I'm looking at, 3 conditions that I am looking at for when the bear market will end, and we can look into a more risk-on bullish environment. Those 3 things are the United States dollar currency index, the Federal Reserve raising interest rates, and inflation. And you can go back several months. This has been the exact same thing. Anybody that actually tunes in on every single one of these videos, I know I sound like a broken record. You'd probably like me to stop sounding like a broken record, but truly, I wouldn't get too excited about any investment opportunities until those conditions are met. So what do I mean by that? The federal funds rate needs to hit its terminal rate and flatten out, which again, according to Jerome Powell, that is probably going to look something like this and then flatten out. I went a little high there. Actually, something more like that and flatten out, right? That's what we'd expect to see. It doesn't need to necessarily go down for us to see price appreciation in our more risk-on investments like equities and cryptocurrency, but it does need to stop rising, right? Once it stops rising and flattens out, then you can start looking at some of these other conditions, right? Where we look at, like I said, inflation. There's the United States inflation rate. Inflation, as far as I can tell, has not topped out yet, right? I'm not going to say that it's topped out just because it's decreased a little bit month over month, right? You could have said that here, and you could have also said that here. With the Federal Reserve raising rates so many additional times over the next 6 months, I would expect the top to be inbound within the next 6 months. I can't say that for sure. We don't know what the future holds, but with supply chain pressure coming down, with the housing market starting to deflate, with unemployment going back up, with commodities starting to fall back down, assuming the war efforts around the world don't worsen significantly, I would expect inflation to start coming back down within the next 6-ish months. That's kind of where I'd expect inflation to start topping out. So that's exciting. I think that's the first time I've said on one of these videos that, there's a realistic timeline for inflation to stop topping out. And the other thing, the final thing, is the United States dollar currency index needs to stop its absolutely relentless tear to the upside. And let me just zoom out to show you guys like how crazy this move has been. Like, it is literally just parabolic to the upside. No effort whatsoever, no resistance whatsoever. It just keeps smashing resistance after resistance. And that's because, like I said, for as bad as our inflation issue is currently, compared to the strength of other currencies around the globe, the United States dollar is doing significantly better. Other currencies are literally melting down right before our eyes. It's a super serious situation that is probably going to cause a lot of grief in the future, if it isn't already, right? Now, the dollar, I'm less convinced it has topped here, right? Every single time that it goes into a downtrend, it just kind of, tests some previous high and then it starts tearing back up again. So what we would like to see is a true lower low on the United States dollar currency index, which means next time it goes into a correction, right, it doesn't just rip back up without visiting any of these previous lows that it made. Instead, I'd be much more convinced of the dollar topping out. We put a lower low, right? And then maybe we rally and we put in a lower high, right? And then after that lower high, if we go in and put yet another lower low in, then all right, cool. I'd say, it looks like we're bottoming there, or topping rather, but bottoming in the equities and cryptocurrency situation. So that's kind of where I'm at with everything right now. If you have any opinions or questions or thoughts, feel free to let me know. But yeah, bottom line is the Federal Reserve is going to keep raising interest rates. They stated that very clearly, and they stated that that is going to cause recessionary pressure, that is going to raise unemployment, and that is going to cause a correction in the housing market. Again, this is not speculation. These are literal things that came out of Chair Powell's mouth at the most recent FOMC meeting. And I have reason to take that seriously, because if you didn't take his comments seriously, then you're probably down pretty bad in most of your investments, had you had not acted on his words of the past 6 months, right? The Federal Reserve has definitely delivered as far as their promise to raise interest rates and cause recessionary pressure on the economy recently. So again, I appreciate your attention, and I will see you guys next time for a video explaining why I think Bitcoin is a generationally important asset, and explaining in as few arguments as possible why I believe that's the case, and why even amongst this recessionary pressure, I think it's a very important asset that will be very prominent for years to come. So until next time, I will catch you guys later. Peace.